All right, thank you so much for your patience as we had some technical difficulties getting started. So thank you so much for joining another session of the My Solo 401k Financial weekly YouTube video series. Today we're going to be talking about a very popular topic: how much income do I need to maximize solo 401k contributions? So today's session is specifically geared towards those self-employed businesses that are taxed as a sole proprietor, a single member LLC, a 1099 NEC independent contractor. So if you do have questions, please chat those over in the chat box, and we will go through those sequentially after we get a chance to go through the slides. All right, so the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor is it a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Today's agenda is, again, how much self-employment income do I need to max out my solo 401k contributions? We're first going to just touch on a couple of quick resources, talk about the basics as far as who's eligible to set up a solo 401k, some of the top use cases, go through the solo 401k contribution basics, because that'll set the stage for the answer to the question of how much self-employment income do I need. So let's jump in. So first off, we host daily live Zoom style calls on our My Community, mysolo401k.net/My Community. It's always free to join. All are welcome. We also have forums on the community. We have a video library with hundreds of videos. So there's a lot of great resources out there. As far as the eligibility, who is eligible to set up a solo 401k? Well, it's really for a self-employed individual. So think like an independent contractor, maybe a solo practicing realtor or attorney or CPA. The individual has to be an owner-only business. In other words, there's no non-spouse, non-owner, full-time W-2 employees. You could have contractors, you could have a business partner, could be two spouses that are working in the business, but there can't be any non-owner, non-spouse, full-time W-2 employees. As far as some of those top solo 401k eligibility considerations, do I need a separate entity like an LLC or an S corp? The answer is no. We have many clients who are operating as sole proprietors. They don't have a formal legal entity for their business. Now, you do need to report earned self-employment income on your taxes. So if you're being taxed as a sole proprietor, that would be on Schedule C. Or let's say you do have an S corp for your business, then that would be W-2 wages from your business taxed as an S corp. There's no minimum amount of earned self-employment income that you need in order to be eligible to set up a plan. But of course, if your goal is to be able to make contributions, your ability to contribute is a function of that earned self-employment income, because you can't save more than you earn. Your spouse or business partner can also participate in the plan, as long as your spouse or business partner is also reporting their own earned self-employment income. Like you each receive W-2 wages from the S corp, or you each file a Schedule C. In that case, it would be one plan sponsored by that one business, but separate accounts for each participant. You can have a solo 401k even if you have a W-2 day job, even if you're participating in your W-2 employer-sponsored plan. Some of the top reasons, so the benefits, some of the top reasons or use cases would be contributions, right? With our plan, you can save as much as $66,000 or even $73,500 if you're 50 or older for 2023. And those solo 401k contributions can be made as pre-tax contributions if you want to reduce your taxable income, or they could also be made as Roth or Mega Backdoor Roth contributions, in which case you wouldn't be able to reduce your taxable income for the year for which you make the contribution, but you have that potential for tax-free growth. So the solo 401k has the highest contribution limits for any defined contribution plan available to self-employed individuals. Another top use case would be the ability to invest in alternative investments. So of course, our plan allows for investing in traditional brokerage types of investments like stocks and mutual funds, but it also allows for real estate, notes, or other types of alternative investments. And as part of the onboarding process, we're helping our clients open up accounts at the bank or brokerage of choice where they're going to have checkbook control over the money, which is important based on feedback and experience, because now the solo 401k owner can act quickly to invest and to take advantage of an investment opportunity. Lastly, one of the top reasons that clients set up accounts with us is the ability to take a 401k participant loan. So this is where the solo 401k owner is literally borrowing money from their own solo 401k account. Now that has to be documented as a loan. Otherwise it would be considered a taxable distribution. As part of our services, we're preparing the solo 401k loan documents to meet that requirement. The funds then can be used for any purpose whatsoever, right? You might use it to pay your kids' tuition or to remodel your home or pay off a credit card, whatever the case may be. As far as the terms of the loan, you can borrow up to 50% of the balance, not to exceed $50,000. So if you at least have $100,000 in value of your solo 401k, you can borrow 50. It has to be paid back either monthly or quarterly, equal payments of principal and interest. Now the interest is either prime plus 1%, or it could be a CD rate plus 2%. And those payments are spread out over a 5-year term. And of course, as part of the solo 401k loan documents, we're preparing that payment schedule. So again, one of the top reasons is the ability to contribute to the solo 401k. So in determining how much that you can contribute, there are certain, your ability to contribute is based on certain factors. So one we touched on before is your self-employment income, right? You can't save more than you earn. Another would be your age. Once someone is 50 or older, they're eligible to make catch-up contributions. Another would be whether you are participating in making contributions to another plan, like a day job plan. And we'll touch on that once we go through the scenarios at the end of the slides here. Lastly would be the type of contribution. So with our plan, you can make pre-tax contributions, you can make Roth contributions, voluntary after tax. You could be making these contributions as employee or employer, and each sort of subtype has their own separate sub-limit to consider, which we're going to walk through as we look at the following slides. So again, the starting point though is self-employment income. So what your self-employment income is depends on how your business is taxed. So for a business taxed as a sole proprietor, income reported on Schedule C. It could be a single member LLC where it's just disregarded and it flows to your Schedule C or your 1040, a 1099 independent contractor. For someone whose self-employed business is taxed in that fashion, self-employment income is equal to line 31 of Schedule C less 1/2 of the self-employment tax. So you have to do a pre-calculation to figure out, okay, what is self-employment compensation? And of course, you're not going to be able to consider W-2 wages from your day job. You're not going to be able to consider investment income, like income that's reported on Schedule E, for example. Now, of course, there are other types of self-employed businesses in terms of how they're taxed, right? S corps. Last Friday, we did a session on how much income I need to max out contributions for a self-employed business taxed as an S corp. So if you go to the YouTube channel, you can easily find last week's recording. The next session we're going to do is going to be focused on partnerships. So we're going to cover all the bases. So again, for a self-employed business taxed as a sole prop, a single member LLC, independent contractor, where that income is being reported on Schedule C of your 1040, you have to run a pre-calculation, which of course we're helping our clients with. We have an online calculator, etc. But the pre-calculation is your net income reported on Schedule C. So that would be line 31 of Schedule C. So for example, if you have a cell phone bill, you've got an office you rent, right? This is your net income after those business expenses, less 1/2 of the self-employment tax. And of that number, you're then able to make those solo 401k contributions. So as I mentioned, there's another factor is the type of contribution that you're looking to make. So let's first start out by talking about employee contributions. Those are also referred to as salary deferrals. So the employee contribution limit is 100% of your self-employment compensation, not to exceed $22,500 or $30,000 if you're 50 or older for 2023. Now, as I mentioned, another factor is, okay, are you making contributions to another plan, like a day job plan, right? In that case, the employee limit applies at the employee level. So your ability to contribute to the solo 401k is reduced by employee contributions made to another plan, like a day job 401k plan. So if you max out your day job 401k contributions, even if you are separately self-employed with no full-time W-2 employees working for your business, you're not going to be able to make any more employee contributions to the solo 401k. But as you'll see, we can make other types of contributions, but at least the employee limit would be reduced by those day job 401k contributions. Now, one exception to that rule that you have to aggregate for all contributions made by the employee to any plan that the employee is participating in would be contributions to a 458 governmental plan. Those contributions are not aggregated. Now, those employee contributions, those salary deferrals, they can be made as pre-tax, or they could be made as Roth, or it could be a mixture of both. If Roth contributions are going to be made, they need to be deposited into a separate sub-account for each participant. And of course, as part of the onboarding process, we're helping clients open up the requisite number of accounts. Profit sharing contributions, employer contributions, that's the next type of contribution we're going to talk about. So here the limit is 20% of your self-employment compensation. So again, you start with that pre-calculation, line 31 of Schedule C, less 1/2 of the self-employment tax. And then of that number, you can contribute 20% as an employer contribution, also known as a profit sharing contribution. Now, of course, you have to consider the overall limit, which for 2023 is $66,000 or $73,500 if you're 50 or older. So you aggregate all the different types of contributions that you make to the solo 401k, right? The employee, the employer, the after tax, which we're going to talk about next. Now, we talked about how the employee limit applies across all plans that the employee participates in, unless it's a 458 governmental plan. The employer limit, in contrast, applies at the employer level. So let's say that you do max out the day job 401k contributions. Well, that's not going to reduce your ability to make employer contributions to the solo 401k. Likewise, contributions made by your day job employer, like a matching contribution to your day job 401k plan, would not impact or reduce how much you can contribute to the solo 401k. Now, one exception to that rule that you don't have to aggregate for purposes of the employer limit would be contributions made to a 403B plan. There, you'd have to aggregate all the contributions made to the 403B plan, either by you or on your behalf, with those that are made to the solo 401k, and the total made to both the 403B and the solo 401k can't exceed the overall limit. Now, a question that we've been fielding, this year, since a change was made to the law at the end of last year, is the ability to make employer contributions as Roth contributions. So at the end of last year, with Secure Act 2.0, employer contributions can now be made as Roth contributions. While that, is an important change for a plan like ours that allows for Mega Backdoor Roth contributions, that change offers no substantive advantage. And here's why. So with a plan like ours, again, that allows for the after-tax contributions, you're going to be able to more quickly max out the solo 401k in terms of those Roth contributions, right? Because we talked about with the employer limit, it's 20% of your self-employment compensation. And so if you want to make a $2,000 employer contribution to the Roth, you need to have $10,000 of self-employment compensation to justify that contribution. Whereas, as we'll see when we talk about the after-tax contribution limit, the after-tax limit is 100% dollar for dollar of your self-employment compensation. So if you had $10,000 of self-employment compensation, you could contribute it all 100% as an after-tax contribution. So you'll more quickly and more easily get to that overall limit. So that's an advantage for the after-tax contribution. From a deadline perspective, the deadline is the same. So it's a wash. From a reporting perspective, as you'll see on the next slide, there's uncertainty about how to report employer Roth contributions. From a flexibility perspective, there's an advantage with the after-tax contributions because per this last bullet on this slide, after-tax contributions can be transferred out of the solo 401k to a Roth IRA without having to meet any type of triggering event. Whereas if one is making Roth employer contributions and they wanted to transfer those funds out to a Roth IRA, they would have to meet a triggering event. Typically, that means being at least 59 and a half years of age or older. So again, the bottom line is that for a plan like ours that allows for the Mega Backdoor Roth contributions, this change to allow for employer contributions as Roth contributions offers no substantive advantage. And here's some more FAQs, and we're going to have these. We've got these slides posted on our website, on our blog, so you can deep dive this, after the fact. Again, the next type of contribution is those after-tax contributions, and this is how one is making Mega Backdoor Roth solo 401k contributions. So the limit for those voluntary after-tax solo 401k contributions is 100% dollar for dollar of your self-employment compensation. Recall again, that's line 31 of Schedule C, less 1/2 of the self-employment tax. And those contributions can go all the way up to the overall limit, which is $66,000 for 2023. Now, of course, you have to consider all the different types of contributions that are being made to the solo 401k. So if you are also making employee and or employer, then you'd have to include those in making sure that the total amount of contributions doesn't exceed the overall limit. It's also interesting to note that the limit doesn't technically go up if you're 50 or older, right? So if you're 50 or older for 2023 and you have the self-employment compensation to justify it, you can make a catch-up contribution of $7,500. So if you're trying to make after-tax contributions, let's say you have $100,000 of self-employment compensation, so you have plenty of self-employment compensation, you can make a $66,000 after-tax solo 401k contribution. Now, if you're 50 or older, the question becomes, okay, what about the catch-up? Can I make that as an after-tax contribution? The answer is no. You'd have to make that as either a pre-tax employee contribution or a Roth employee contribution. So ultimately, you're still able to make the $73,500. You just don't make that catch-up as an after-tax. Another consideration is what about contributions made to another plan, right? We know with our standard employee contributions, right, the 22.5 made either as a pre-tax or a Roth, you have to reduce that limit by contributions made to another plan, like a day job plan. This is not like that. After-tax contributions are not aggregated. They're not impacted by contributions made to another plan, like a day job plan, unless, of course, the other plan is a 403B plan, in which case you do have to aggregate. Lastly, after-tax contributions have to be deposited into a separate sub-account, right? So for individuals, that are making all different types of contributions, or they have all different types of funds, maybe they're rolling over money to the solo 401k, they may have a pre-tax sub-account, a second Roth solo 401k sub-account, and then a third voluntary after-tax solo 401k sub-account. And of course, as part of the onboarding process, we're helping clients open up all the requisite number of accounts that they need for whatever they're looking to do. All right, great. So now that we've laid the foundation, we can start to go through the scenarios to answer the question of, okay, well, how much income do I need to max out the solo 401k? So maxing out the solo 401k means different things to different people, right? For some people, it means, okay, I want to max out my contributions, but still keep my self-employment income as low as possible. So here, we're going to first lay down or describe the assumptions, and then we'll go through the scenario. So here we're first assuming, of course, that the self-employed business is taxed as a sole proprietor, a single member LLC, right? An independent contractor where the individual is receiving a 1099 NEC, or what used to be called a 1099 miscellaneous. Let's assume that it's just one participant. This person does not make contributions to another plan like a day job plan, and they want to contribute 100% of their self-employment compensation, but really only make the employee contribution, the salary deferral. So how much self-employment income would they need? So again, you have to do that pre-calculation. So if this individual, let's assume they're under 50 and they have at least $24,211 reported on line 31 of Schedule C, so their net income, that means that their self-employment compensation is going to be $22,500, because right, that line 31 of Schedule C is reduced by 1/2 of the self-employment tax. So this person is then going to be able to contribute 100% of that self-employment compensation as an employee contribution, right? That could be made as either a pre-tax contribution or as a Roth contribution. Now, if they're 50 or older, they're also able to make the catch-up contribution, but they would need additional self-employment income to justify that, right? Because you can't save more than you earn. So if you're 50 or older and you want to contribute the 22,500 plus the 7,500, you would need line 31 of Schedule C would need to be at least $32,281. And then that would be reduced by 1/2 of the self-employment tax, would give you $30,000. And again, you can contribute all of it as an employee contribution to the solo 401k. All right, let's talk about scenario number 2. So here, again, the individual wants to maximize their solo 401k contributions. They want to keep their self-employment income low, but let's assume that, so they still want to contribute 100% of their self-employment compensation, but let's assume they also want to make the employer contribution. So same scenario, right? Taxed as a sole proprietor, independent contractor, reporting on Schedule C, one person who doesn't make contributions to another plan, and they want to contribute 100% of their self-employment compensation, but also make those employer contributions. So we know that they'll need the self-employment income to justify the contribution, right? Because you can't save more than you earn. So the question becomes, okay, well, how much do I need to report on Schedule C? So if the individual's under 50 and they have at least $30,263 that's reported as net income on line 31 of Schedule C, that means that their self-employment compensation would be $28,125. So now they're going to be able to contribute $22,500 as an employee, 20% of that self-employment compensation, which is $5,625. So now they're contributing all of their self-employment compensation as both the employee and employer. If they're 50 or older, they're going to need more self-employment compensation because they've got to justify that $7,500 catch-up contribution. So someone who's 50 or older, if they have at least $40,351 on line 31 of Schedule C, then their self-employment compensation would be equal to $37,500. So they'd be able to contribute $30,000 as an employee, 20% as an employer. So they end up contributing 100% of their self-employment compensation between employee and employer to the solo 401k. Okay, now let's change up the scenario. Again, maxing out the solo 401k means different things to different people. Let's assume for this person, it means they really just want to maximize and make the full, up to the overall limit, the full contribution to the solo 401k. And they want to do it on a pre-tax basis to reduce their taxable income. So we're still dealing with the self-employed business taxed as a sole proprietor, meaning the single member LLC, or maybe an independent contractor who gets a 1099 NEC. It's just one person who doesn't make contributions to another plan. Again, they want to maximize those pre-tax contributions, meaning make both the employee and the employer. So in that case, they're going to make, if they're under 50, they'd make $22,500 as an employee pre-tax, plus an additional $43,500 as an employer pre-tax. So that now they're making $66,000 in contributions to the solo 401k for 2023. And then an additional $7,500 if they're 50 or older, right? Which would go into, again, to that employee pre-tax contribution as a catch-up contribution. So if this individual would need to report $230,520 on line 31 of Schedule C, which means that self-employment compensation would be $217,500. They could do 100% as an employee contribution, either $22,500 if they're under 50 or $30,000 if they're 50 or older, and then 20% of that self-employment compensation as an employer contribution. So that would be $43,500. And then they'd be able to max out the solo 401k. It would all go in as a pre-tax contribution to reduce their taxable income for 2023. All right, now let's flip to a different scenario. Here, this individual, when they say they want to max out their solo 401k, they're referring to making Roth contributions or voluntary after-tax contributions. So again, it's the same type of self-employed business, right? Taxed as a sole proprietor, a single member LLC, reporting that income on Schedule C. It's one participant who does not make contributions to another plan like a day job plan. And again, their goal is to maximize Roth and or voluntary after-tax contributions. And again, we're going to assume that all the employer contributions are made as pre-tax and not as Roth, because making employer contributions as Roth contributions offers no substantive advantage over Mega Backdoor Roth solo 401k contributions. Okay, so in that case, this individual is going to make and let's correct this real quick. Sorry about that. We got a typo on the slide. Let's get it corrected. You're going to make that employee contribution as a Roth contribution. So they're going to make 100% of their employee contribution as a Roth contribution. If they're under 50, that would be $22,500. If they're 50 or older, that'd be $30,000. They're not going to make any employer contributions because those would be going in as pre-tax contributions. And here their goal is to make all the contributions as Roth or after-tax contributions. And then they're going to want to make a voluntary after-tax contribution of $43,500, which would mean that they could then transfer that after-tax money to the Roth solo 401k. So that at the end of the day, they would have $66,000 in the Roth solo 401k or $73,500 if they're 50 or older. So how much self-employment income would they need to be able to accomplish this? Well, if they're under 50, they would need at least $71,018 reported on line 31 of Schedule C, because this would mean that their self-employment compensation after reducing by 1/2 of the self-employment tax is equal to $66,000. If they're 50 or older, they would need to report at least $79,088 on line 31 of Schedule C, because now they would have $73,500 of self-employment compensation, right? So once they have that amount of compensation, they're going to be able to contribute 100% dollar for dollar up to $22,500 as an employee or $30,000 if they're 50 or older. And then they could do the difference up to the overall limit as an after-tax. Again, the after-tax contribution limit is 100% of the self-employment compensation. So it's just dollar for dollar. So that's what this individual would need in order to justify making those max Roth and Mega Backdoor Roth contributions for 2023. All right, that takes us to the end of the slides. As I mentioned, we do have another presentation that's out there on the YouTube channel from last week. You can easily find the recording. That one was dedicated for self-employed businesses taxed as an S Corp. Again, we have community forums. We have our daily Zoom calls on our community. You can email us at business@mysolo401k.net. So lots of ways to communicate with us. We really appreciate all the good participation. Thank you so much. Please like and subscribe if you're on the YouTube channel. Again, as we'll be back with more of these deep dive webinars next week, focusing on self-employed businesses, taxes, partnerships, and then we'll go on with additional important topics. So let's start to go through the slides. Thank you so much for, let's start to go through the questions. Excuse me. Thank you so much for going through these slides with me. So let's see. Are employer 401k contributions tax deductible to the business, you, the employee? Most definitely, as long as they're made as pre-tax contributions. So we have, earlier in the year, we did some deep dive sessions on, all the contribution procedures, right? How to make the contributions, how to report, et cetera, et cetera. We call them our contribution guides. And so, of course, we talked about how to report both the employee and the employer. You can easily find it on our contribution guides page. I'm pulling up a link to that page here. 1 second. You can see that we have it broken down by how the business is taxed, right? So there's the one for sole proprietors, and we scroll down to this page here. You can see that employer contributions are reported on line 16, schedule 1 of the 1040. So let me chat over a link to this page, and you can go out there and take a look. There's videos as well. You can watch it as a video. So thank you so much. I have an LLC with an S election. Would I be able to max my pre-tax as the employee and then put $43,500 into the Mega Backdoor Roth? So that's a great question. As I mentioned, we did last week, we did the session that was dedicated for self-employed businesses taxed as an S Corp or C Corp. So let me pull up a link to that session so you can also grab it here. 1 second, please. Okay. Here's that link to that session. So, but the short answer is yes, as long as you have the W-2 wages to justify the contribution. So, for example, if you have at least $66,000 of W-2 wages from your self-employed business taxed as an S Corp for 2023, and you're not making contributions to another plan like a day job plan, and let's say you're under 50 years of age, you'd be able to put 100% of those W-2 wages dollar for dollar as an employee contribution up to $22,500, and then you could put the difference as an after-tax contribution to the separate after-tax account. And then you can move it over to the Roth account. So you'd have $22,500 in your pre-tax account and $43,500 in your Roth Solo 401k account. So please, I see the next question there. Please send us an email at business@mysolo401k.net with your phone number. If you'd like to have a conversation. Otherwise, you can go, of course, directly to our online application and get started today. Let me pull up a link to that online application. Thank you so much for your inquiry. And if you want to be copied on the communications, please just include, of course, it's going to be the client's information, but what a lot of advisors and who we work with a lot of advisors, if they want to be copied on the communication, they'll just simply put their name and email address in this final field, right? It could be like Main Street Trust as the name of the plan. Please copy name and email. And then we copy the advisor on the communications. But here's the link right here to the application. Thank you so much. Okay, so we'll look out for that. We'll go grab that. Thank you so much. Is it possible to do a pre-tax contribution today for the S Corp? I'm assuming you mean for 2022. So no, it's not going to be possible to get the accounts set up in time to be able to make a contribution for 2022 for an S Corp. Of course, if the individual is located in a county that was impacted by a federal disaster and received an extension to file their tax return from the IRS, for example, pretty much all the counties in California are under that automatic extension until October 16th, then there would be time. So hopefully that helps. All right, I don't see any more comments. Thank you so much for the good participation. Please continue to participate. Please like and subscribe so you can get notifications when we do these daily webinars. We also post videos on a daily basis. Again, we host daily Zoom calls on our community. You can post questions 24/7 in our forums, et cetera, et cetera. So thank you so much. Right. So if they're on an extension, that means that the tax deadline is today. So yeah, it's not going to be possible to get an account set up in time to make a contribution by today. We don't hold or have access to any of our customers' money. We help them open up accounts at the bank or brokerage of choice. But of course, those bank or brokerages, they're not going to be able to open up an account at this time, this late day, this late hour. So if they're reporting their income on their 1040 and they filed a timely extension for their 2022 1040, then they would have until October 16th and there would be time. So, but we'll look out for your email. Thank you so much for participating. So all the best, everyone. Take care. Thank you so much.